Hi, this is James Zane with Full Capital, and I've got Robert Cannaday here with me. Robert, how's it going?
It's going well. How are you, James?
Well, I appreciate you jumping on, and the conference is coming up here in a couple months in October, and so I wanted to bring you on and just chat about sort of what you're seeing out there right now, and also give people a little introduction of who you are. So maybe let's just start there and go through sort of your background a little bit, and then we'll get into what your bank does.
Sure. Well, as you said, my name's Robert Cannaday. I actually grew up where I work. I grew up here in Frisco, Texas, and I still work here to this day. I work for Great Plains Bank as the market president, and I have been here now for a little over 4 years now. Prior to that, I was at a larger bank where I was for 10 years, and kind of how I got started in banking. I started as a teller while I was at the University of North Texas over there. Graduated with an economics degree, and after I graduated, I moved to the credit department where I underwrote all sorts of different commercial real estate types and commercial loan types for about 2 years. And after that, I got onto the kind of more outbound, more sales side as a commercial lender, and then finished my time over at that bank. And as most things, all good things come to an end. And I came over here to Great Plains Bank, where I've been ever since.
So you grew up in Frisco,
I
and
did.
do you remember when you graduated, how many people lived in Frisco?
I don't remember the exact population, but I think it was right around 20,000.
Okay, so it's 10x that number
Yes,
since okay, so it's still growing. But yeah, we probably have 200 or 300,000 people here in Frisco now. Um,
a lot different, that's for sure.
so you've been in banking pretty much your whole career. What are you seeing? You can start sort of at the macro level, maybe at the banking side, or even start sort of at your bank specifically, like because I think sometimes people have a challenge of, okay, what's different about this bank than the other bank? Like they know
Sure.
Bank of America, but besides that, what else? Like tell us a little bit more about your bank and what you guys specifically do a lot of.
Sure. So kind of from I guess macro perspective, I think all banks are kind of tightening up just a bit. So we're one of those banks that is also tightening up. That doesn't mean we're not lending. We're still lending quite a bit,
So,
but
all right, I'm gonna jump in. Why?
okay.
Why are you tightening right now? Or
So
why is
just
it tighter?
sure.
Yeah,
Really just uncertainty in the market. Just the trends in certain asset classes have not been on that, huge upward trajectory that we've seen over the past, call it 10 years or so. Things are just starting to level off. And so, while we used to underwrite more to projection, we would put in a lot of, rent growth or occupancy growth, and kind of lend more speculatively. Now we're lending more on the stabilized side of things. We want to see an asset that is cash flowing, can support the debt. We might build in a little bit of projection based loan proceeds, but for the most part, we're lending on stabilized assets. And from a banking perspective on what we look for in a deal compared to other banks and how we kind of have a comparative advantage is a lot of banks will look only at the asset class when making a decision. But for us as a bank, if there is kind of a value add component to it, or there's some upside to be had in a property, instead of just looking at the property and saying, no, this property has upside, but we don't want to lend on it because of certain cash flow metrics. We can still look at a projection and say, the guarantors here on this deal have a lot of cash, they have a lot of liquidity, they have good, cash flow coming in from other assets or income sources. So we can make a little bit more of a risky loan than other banks can. And so
so you,
that's kind of how we we have our competitive advantage in that we look at the whole picture rather than just the asset. While we do prefer a stabilized asset, we do have some wiggle room there.
Okay, so you're gonna underwrite the property to, 1.0 or 125 debt service coverage, but then you're also gonna look at the guarantors and maybe they have a spouse that works as a doctor or some sort of secondary source of income, and then
Yep,
put that on top of the underwriting that you have with the property,
exactly right.
essentially. Okay.
Exactly right.
Um, I didn't prep you too much for this call, but do you have any maybe high level, just sort of recent deals that you guys have closed that you can talk about, or you can give just sort of general idea of typical asset type and any high level loan terms that you're offering right now?
Yeah, so we haven't done too much multifamily this year, but we have done quite a few other asset types. Oddly enough, the thing we've done the most of this year has been SBA or small business loans. We've done quite a few daycares. We've done some commercial kind of commercial services companies, but those SBA loans are kind of a hot commodity these days. As for real estate, we have done some owner-occupied office. We've done a few builder lines of credit for single-family homes. We've done some townhome construction projects. So we are still lending in real estate, but like I said, those small business loans have been the majority of our production here in Texas this year.
What's the leverage on SBA loans? Just
So they can
for
go. So so on a business purchase loan, we can do 95% leverage. And I'm sorry, the seller can carry a 5% carryback note and the buyer can put in 5%. So effectively to the buyer, it's 90, but we're looking at it kind of more 95%.
total loan. Yeah, total loan
That,
proceeds.
that's
Okay.
correct. But
Okay.
yeah, call it call it high leverage 90%.
And that's yeah, that's similar. So that's for like more like operating type businesses, like the typical standard that I'm seeing on Facebook and social media is like a laundromat. Like you can get it. Is that right? Like
I mean, we could do laundromats. It's
yeah.
not probably our specialty, but we can do those. But yeah, that's one of the asset classes that it falls into.
And then, I mean, a lot of people, that are coming to this conference, they are in sort of the multifamily space. What are you seeing sort of in that arena right now? Just whether you guys have loans outstanding in multifamily or even, new loan requests. What are you seeing in that space right now?
Yeah, new loan requests are, I guess, good new loan requests are kind of down across the board. We are seeing some pretty good ones, but they're highly competitive with interest rates from other banks. And the existing portfolio, I would say, is kind of uh, it's just kind of surviving. Close to 1 ODSCR on each property. Guarantors and sponsors are having to occasionally cut checks to make property tax payments and make some deferred maintenance payments and whatnot. But multifamily portfolio is just kind of staying afloat at this point.
All right, so let me ask a better question.
Okay.
So what would you like to see? Because a lot of people who come to our conference, they're like general partners who have existing properties or potentially new general partners or limited partners. What would you like to see in the sponsorship group if they were coming to your bank?
Yeah, so I'd like to see a good experience. Obviously, experience goes a long way. Um, and I'd like to also see a decent amount of equity in each deal. If we're going to be, extending a loan on a property, kind of going back to what I said earlier, we'd like to see it be stabilized. We'd like it to generate a conforming debt service coverage ratio. And if the properties do meet those, as is in place metrics, we can get very competitive on interest rate and terms because we do want those stabilized deals.
Okay. And then we were at lunch earlier this year, and you gave me like the 4 or 5 C's of credit. Hit me with those again. I'll put you on the spot because
Okay.
I was unfamiliar with these C's.
Yeah. So we
Uh,
got five C's of credit. So you got character, you got capacity, collateral, capital, and conditions. And those are kind of the five high level points that every underwriter and every bank is going to look at. If you check all five boxes, you've got yourself a deal. And
Okay.
so, kind of
Yeah.
breaking those, do you want me to break those down?
I would love for you to break those down. Yes,
Okay.
for
So character, borrower's character is number one for a reason. If you make a loan or you get into an investment deal with someone of bad character, it's not going to go well.
right.
Banks are the same way. So we analyze character, and there's a few ways to do that. You can call references, you can look at experience, you can pull credit, but generally just meeting the borrower and getting a good feel for them. You can kind of tell a bad actor from a good actor in a 1 or 2 hour conversation pretty easily. So you have character, then you have capacity, and that is the capacity to repay. How well does the underlying asset cash flow? How well do the guarantors generate income that can support the debt if needed? So character, capacity. Then you have the collateral. That is, worst case scenario, the bank has to take it back. What does the bank have? And so that comes into the next point, which is capital. How much capital is in the deal? How much equity is in the deal? 90% loan to value, that's high risk. 55% loan to value is pretty low risk. And then the last is conditions, and those generally just mean market conditions. What is the market doing at this point? So you meet all those five C's, and you got yourself a deal most likely.
Most likely. So,
Most likely.
well, I appreciate you because I do think it is challenging for people who come into the space and they're like, well, how come like all these banks want to approve my loan? And it's like usually one of those things is missing, right? So like,
Right, right. That's
or you
exactly.
have three. Like what I like to say a lot of times when I'm on the phone with somebody is like, well, you don't have this, you don't have this, you don't have that. So that's
Right.
three strikes and you're out. So
Yep, that's
fix those
exactly
three
right.
things and then bring it back and then you'll have a deal. So,
Yeah.
um, you will be at the conference in October. So I appreciate you guys sponsoring this year. And, you've been, I don't know how I think this is nine. I think we've done nine conferences.
Yeah.
Um, so who do you think this conference is good for and sort of why should they come out to the conference? You've been,
Anybody that's interested in investing specifically in multifamily, but every time I've gone to these conferences, you meet all sorts of different real estate investors. So anyone who's got an interest or already is in multifamily, whether that's from, investors to property managers to vendors, it really just, I mean, it attracts everyone involved in commercial real estate that you could potentially benefit and do business with.
Perfect. Robert, what's the best way for people to reach out to you if they have either a question or want you to take a look at something?
Sure.
What's the best way for people to reach out to you?
Yeah, via email. And my email is rcannaday@gpbanktx.net.
Okay. All right. Great. Thanks for coming on, Robert.
All right. Thank you, James.
All right. I see you.